Welcome to the Deep Dive. We're your shortcut to getting up to speed on the big complex stories shaping our world. And today, we're definitely tackling a big one. It's this surprising, really significant development, the new U.S. tariffs on India. Now, this isn't just your standard trade dispute. It's got these deep geopolitical layers that honestly are quite fascinating when you start digging. Our mission today, we've got a stack of reports here, mainly from MK Global and Goldman Sachs. We're going to distill the key insights for you, give you a clear, concise picture of what's happening, why you should care, and what might come next, without burying you in jargon. Okay, so let's unpack this. The headline that kind of dropped recently was the U.S. slapping India with 25% tariffs. And on top of that, the threat of additional unspecified penalties. These reciprocal tariffs are supposed to kick in August 1st. It's quite a sudden shift, isn't it?
It really is. And I think the crucial thing to understand here is the background. This isn't happening in a vacuum. These tariffs are coming after long drawn-out U.S.-India talks that seem to have just, broken down. The core issue, what the sources call the main bone of contention, seems to be India's refusal to open up its domestic agriculture and dairy markets.
Right, that's been a sticking point for a while.
Exactly. But here's the twist, the new dimension the reports highlight. Those threatened penalties. They're explicitly linked to India's ongoing defense and energy relationship with Russia.
Ah, okay. So that changes the game entirely.
It really does. It makes this far more complex than just haggling over butter and tractors. It's deeply geopolitical now.
That absolutely adds layers. Okay, so beyond the big picture strategy stuff, people are obviously asking about the immediate impact, the money. You hear these figures like India's exports to the U.S. are only 2% of GDP. That's MK or Goldman Sachs saying it's around 4% of GDP going to U.S. final demand. And initially you might think, okay, 2%, 4%, maybe not a catastrophe.
Yeah, it's easy to look at those percentages and maybe dismiss it, but the potential fallout is surprisingly large when you dig into it. MK's static analysis, just looking at the direct impact, suggests that if these 25% plus tariffs go through, India's exports to the U.S. could actually drop by 30 to 33 billion U.S. dollars.
33 billion. Wow.
Yeah, which translates to about 0.8 to 0.9% of India's GDP. That's nearly a full percentage point wiped off potential exports just from this.
Okay, that puts it in perspective.
And connecting that to the wider economy, Goldman Sachs estimates a potential incremental drag of about 0.3 percentage points annualized on India's real GDP growth.
And that's on top of previous estimates.
Exactly, on top of a 0.2 percentage point estimate they already had baked in. So this means there are real downside risks to growth estimates for both 2025 and 2026. That's something investors are definitely watching.
And what about the current account deficit? Does that shift much?
It nudges it up slightly. The reports say it would marginally increase by about 0.1% of GDP for CY25. Takes it from 0.8% up to maybe 0.9%. Not huge, but another pressure point.
So direct hit, slower growth potentially. Are there other, maybe less obvious impacts?
Yes, and this is where it gets really interesting, I think. It's the indirect impact from uncertainty. Basically, when U.S. policy gets unpredictable like this, Indian companies, especially those exporting to the U.S., they get nervous.
Makes sense. They hold back.
Precisely. They might postpone investment decisions. Goldman Sachs actually put a number on this previously. They estimated about a 0.3 percentage point drag on real GDP growth just from a one standard deviation shock that's like a significant jump in U.S. trade policy uncertainty.
So the uncertainty itself acts like a brake on the economy.
Exactly. It's not just the tariffs themselves, but the fear of what might happen next. It creates this chilling effect.
That makes total sense. Okay, so if the overall economy could feel this drag, let's zoom in a bit. Are all sectors hit equally? Or are some taking more of the heat? MK points to textiles, auto, chemicals, pharma, electronics as the key exposed areas. And if you look at the actual top exports to the U.S. for fiscal 25, the big ones are electronics at over 18%, gems and jewelry around 11.5%, and pharma products also over 11%.
Right, but here's where we need to add some important nuance. While pharma and electronics are huge export categories, the reports are clear that they have been exempt from any tariff so far.
Oh, okay, so they're safe for now.
For now, but the sources definitely flag the potential risks if the current exemptions are terminated, so there's a vulnerability there. And, interestingly, the auto sector is maybe better placed than feared.
So.
Well, India just doesn't export that many finished cars to the U.S. And for auto components, there's even a chance they could eventually benefit if tariffs on China, Canada, and Mexico push some business India's way.
A potential silver lining there, maybe?
Potentially. Another key point is just how highly concentrated India's exports to the U.S. are. Get this. Just 16 specific product codes, these HS2 codes, used in trade account for about $71 billion. That's roughly 81% of all of India's exports to the U.S. in FY25.
81% from just 16 product types.
Exactly. So it means only a few large export sectors are vulnerable to tariffs, which is, good in that it might contain the damage, but obviously really bad if you're in one of those 16 categories.
Right, a very focused impact then. Okay, this inevitably brings us to the markets. For anyone watching their investments, what's the reaction? What's happening with the Indian Rupee, the INR, and the stock market? MK sounds a warning bell here, saying brace for volatility in capital flows and asset classes, and that the INR might bear the brunt. In fact, it was apparently one of the worst performing EMFX emerging market currencies in July, down nearly 2%.
Yeah, that rupee volatility is definitely something the Reserve Bank of India, the RBI, will be watching closely. It's likely to feed into RBI's reaction function. It basically ties their hands a bit, partly constraining further new-term easing. Makes it harder for them to cut interest rates to support growth if the currency is unstable.
But is that the only view?
Well, interestingly, Goldman Sachs offers a slightly different angle. They argue that the downside risks to growth, plus the fact that inflation in India looks pretty tame right now, actually raise the risk of another repo rate cut by the RBI later this year.
So a bit of a debate there, stability versus stimulus. What about stocks?
MK suggests we could see a short-term sell-off. They point to maybe weak earnings momentum and valuations not being particularly cheap right now. But their advice is actually to buy any substantial dip.
Really?
Because the really big sectors in the index, like financials, consumption, and technology, are largely seen as unaffected by these specific tariffs. Goldman Sachs kind of echoes this. They see Indian equity underperformance likely to extend in the near term, but they also advise staying market weight, basically. Hold your position and focusing on those domestic alpha pockets like financials and consumer stocks.
So a near-term wobble, but maybe not a disaster for the whole market.
That seems to be the consensus. And a key reason is that the overall earnings impact, the EPS hit, might be fairly moderate. Goldman Sachs crunched the numbers and found only 2% of MSCI India total revenues come directly from these goods exporting sectors. So they estimate only about a 2% incremental hit to EPS if the new tariffs are fully enforced.
Okay, only 2%. That helps explain the buy the dip thinking.
Precisely. While certain companies will feel pain, the broad market earnings might be more insulated than you'd first think.
Got it. Okay, let's pivot back to something we touched on right at the start, that new dimension, the Russia connection. It seems like this isn't just background noise. It's a core part of why these penalties are being threatened. You really have to factor in India's energy and defense buys from Russia. And the numbers on crude oil are pretty stark, aren't they? Russia's share of India's oil imports went from basically nothing, less than 1% in FY22, to around 36% for FY25.
A massive jump, and that was almost entirely driven by the big discounts Russia was offering after Western sanctions hit them.
But is that discount still there?
Well, that's the interesting part now. The sources note the Russian crude discount has been nearly eliminated in recent months. Market forces, more sanctions pressure, it's mostly gone. This actually raises an important question, as one report puts it. If the discount isn't there, does India's incentive to buy Russian crude change? Shifting away might not even change substantially the total import bill now.
So maybe less of a sticking point going forward. Could India offer concessions there?
Potentially. One idea floated is that India could offer to ramp up imports of LNG, liquefied natural gas, and even crude oil from the U.S. as a sort of olive branch.
And what about the defense side? That seems trickier.
It is trickier. The legacy is huge. Nearly 60% of India's military hardware is of Russian-Soviet origin. That means ongoing dependence for refurbishment, spare parts, and maintenance. You can't just switch that off overnight.
Right. Decades of reliance.
Exactly. However, it's also undeniable that India has been significantly increasing defense cooperation with the U.S. in recent years. That strategic pivot is happening. And frankly, closer ties with the U.S. on defense would only help improve India's military capabilities and geopolitical positioning in the long run. So it's a complex balancing act for Delhi.
Absolutely. Okay, so we've gone through the tariffs, the economic ripples, the sectors, the markets, and this crucial Russia angle. Let's try and bring it together. What's the path forward? Is a resolution likely, or is this the new normal?
Well, there's actually a degree of optimism in both reports we looked at. They seem to believe a trade deal will be eventually negotiated between India and U.S.
Okay, so eventual resolution is expected.
Yes, but with a pretty big caveat. They point out that even countries that have managed to strike a deal with the U.S. recently often still face unfavorable elevated tariffs, even after giving sweeping concessions.
So a deal might not mean a full return to the previous status quo.
It might not. The terms could still be tough for India. However, there's also historical precedent that offers some hope, perhaps, for a quicker, better outcome. President Trump has a well-documented history of, well, backtracking or modifying initial tariff announcements.
We've seen that movie before.
We have. The sources list numerous examples: Colombia, China, Mexico, Canada, the EU, Japan, Korea, Indonesia, Vietnam, the UK, where initial high tariff threats were followed by lower actual rates or exemptions after negotiations. So maybe a similar pattern plays out here.
A possibility, at least.
And stepping back, this whole episode is really part of a bigger picture, this ongoing global trade reset, which is probably unlikely to be smooth. One potential side effect could be sort of counterintuitive, a disinflationary impulse for India-Asia if global commodity prices fall or there's a glut of goods due to these trade shifts, while the U.S. itself might actually see higher inflation.
Fascinating potential asymmetry there. All right, we've covered a lot of ground today, really trying to peel back the layers on these U.S.-India tariffs. It's clear, isn't it? This is so much more than just trade figures. It's strategy, it's geopolitics, it's history, all playing out right now. So maybe the final thought to leave you with is this. Considering President Trump's track record of adjusting these things after the initial blast, and given India's own careful strategic dance pivoting towards the U.S. while managing historical ties, what might the actual final shape of this relationship look like, and how fast could things change again? Definitely something to keep watching closely as global events unfold. Thanks for joining us on The Deep Dive.